quick little introduction. What we're going to spend our next 30 minutes talking about is really enhancing yield with cover calls. I have joined with me, I'm Kevin Prins. I'm the Managing Director of BMO ETFs. And I have with me today my guest, Mark Raes, who's the Head of Product for BMO Global Asset Management. And again, one more time, we're going to spend the next 30 minutes and just dive into cover calls and effectively enhancing yield with cover calls. We will have some time for questions at the end, but let us go through this right now and just set the stage for this overall conversation. So first and foremost, bear with me. There we are. First and foremost, a little background about BMO Exchange Traded Funds. BMO Exchange Traded Funds actually is the fastest growing ETF company in Canada and has been that for the last 9 years straight. Overall market share in Canada sitting around the 30% market of overall ETFs here in Canada. And more than just our market share, we have been known for a number of things, fixed income being one of them. We are the dominant provider of fixed income in Canada. The other thing we're actually been known for quite often in the marketplace is this, cover calls. In Canada, we introduced the concept of cover calls in the marketplace and certainly been leading them out there, bringing some innovation in the marketplace again and again and again, as well as providing some unique exposures to different markets. And we'll talk a bit about those a little later on today. Now, first, also setting the stage here too, talking about why the need and why the demand for enhanced dividend strategies, cover calls is specifically. The real key thing behind this that we looked at when we first went into the marketplace was this overall trend here. And I'm just showing you by the graphic line of the blue kind of cascading down. What we're really showing you there, both in Canada and the US marketplace, yields continue to go down year after year after year. And so what that really means is people are looking for new ways of accessing yield in the marketplace. And that's where I really think that cover calls have come in to help people out there, is really provide people other income solutions to really complement someone's portfolio and maybe more of a financial planning solution to really help derive the income that somebody needs in their respective portfolio. When we look at cover calls across the board, what are we really looking at here and why cover calls? First, think about right off the bat, it starts with a base of a good quality dividend, right? And that's key, and we'll talk about that a little later on. But also think when you think of cover calls, you tend to get a little less volatility in there too. Also in that, think about the higher yield, and we'll certainly show you some examples of higher yield, but generally you get about an extra few percent more yield than traditional dividends out there, and that certainly helps out, again, balancing financial planning standpoint. Certainly some tax efficiency in there. That premium we're going to talk about in a second, that really comes out as capital gains that provides some tax efficiency, and ultimately very low cost for these kind of strategies. These are pretty advanced strategies coming to at some low cost in Canada for our ETFs, for example, coming around the 65 basis points mark across the board. And so I want to get in there and really give some initial background, leverage Mark and his expertise in here. Mark, let's start off with some background on cover calls. Maybe we'll hand it to you to give us that initial core background on what we're saying when we talk about what is a cover call.
Sure. Thanks, Kevin, and thanks everyone for joining us today. A cover call is a very interesting income enhancement strategy because unlike a lot of the other things you look out there to add additional income, it doesn't come with additional risk. In fact, it's lower risk than just holding the securities outright. So think of that relative to something like fixed income, where you got to go out to higher risk to get more yield, or leverage, where you got to, obviously have more market risk to get more yield. Cover calls give you more yield without adding risk. So what is it? It's simply holding a stock or a basket of stocks in the case of the ETF, and then writing or selling call options against that portfolio. What you do when you write a call option is you choose an exercise price at some point out in the future, and by selling that, you receive a premium. So that premium is a yield enhancement to your overall portfolio. What's the trade-off? Of course, you've traded away the excess upside of that stock above the strike price. But the important thing about it being a covered strategy is because you hold the stock at any point above that strike price, you're still breaking even. You're not losing money. So by trading away that excess upside and getting a little bit of protection from the premium received, you're tightening your band of returns, a little less on the top, a little less on the bottom, less risk, and more yield from the portfolio. Thanks, Kevin.
Thanks, Mark. And that's a good overview what a cover call or an option is. But let's talk about bringing the two pieces together here. And Mark, you helped put together the slide. What I like about this is kind of highlights that there's a core, and then you're adding on top of it. Maybe you can walk us through what the sources of the yield or sources of cash flow coming from that enhancement. Where does it come from?
Sure. I think when people talk about covered calls or even other option strategies, sometimes you spend so much time thinking about the options that you forget about the actual portfolio. But it's the portfolio itself that really creates that strong yield base. So typically when you see BMO covered call strategies, what we do is we start with a strong base of a sustainable dividend grower portfolio that already gives you obviously a good dividend yield to start off your returns. And the reason that really also helps is it means you don't have to have as much pressure or as much results from the call writing strategy because you've already got that higher yield. So if you're trying to capture, 6-7% yield, if you start with 3-4% in dividend, you're already at least halfway there. So that's the importance of the dividend yield. And of course, a lot of the return of your portfolio is going to be driven by the underlying stocks. So, if you've got a view on banks or energy or gold producers, that's the starting point to think about the covered call portfolio. Then we get to the calls themselves, the call writing strategy. You want to think about volatility. So a more volatile program or underlying, where let's think about stuff like gold or energy in today's markets. Sure, there's a lot more volatility, which means there's more availability for the option premiums. But the problem is those stocks are going to move so much that they're going to be subject to large downside moves. And when you're in a yield or income oriented strategy, you probably don't want that excess downside exposure. Next, think about the option selection. So that was one of the things I mentioned off the top. When do you want that option to expire? The further away that date is, the more you're going to receive on the option premium, just because there's more time involved. But by picking shorter dated options, you actually take advantage of time decay, where the price of the option falls quicker closer to expiry, just simply because there's not any time left. So option selection important that way. As well, the out of the moneyness of the option. What does that mean? It just means how far away from the current market price is that option. So if something is trading at $50, an option at $60 is clearly going to be less expensive than, say, an option at $51. So the further out of the money, yes, it's a little bit less premium, but as well, it gives your portfolio the opportunity to really participate in rising markets. And the next important thing is simply the percentage written on the portfolio. So, is this rules-based? Is this an active approach where you're going from 0 to 100? With ours, we tend to be around 50% plus written. I think that's very important, and it's a nice middle ground because, again, half the portfolio isn't overwritten, so it just continues to move up with the marketplace, where the other half will tap out at the option exercise price. So that just really means overall, gives it a little more breathing room. It means more upside is available as markets start to go up. Thanks, Kevin.
Thanks, Mark. And what is now to highlight on this actual slide here is, think about this. This is actually what's going on inside an ETF for you on a regular basis. This kind of aspect of writing the options and managing the options, plus the dividend selection. Maybe we can dive a little bit more into the dividend selection and this option writing, what's happening inside the ETF piece by piece here, Mark. First, let's start off with kind of the dividend aspect and why it's so important. And then actually maybe talk us to the actual approach for selecting the dividends next. And I'll advance the slide when you're ready for that too.
Sure. Well, I mentioned the portfolio a little bit off the last, but really having a dividend, number one, is a great base for the call writing strategy. But two, just even on its own, dividend growing stocks, when we split the marketplace up, clearly exhibit over time the better return profile, and as well, just as important, lower risk. So again, higher return, lower risk, that's a great way to start off the portfolio. And what I would draw a line between really is the difference between a dividend grower versus a dividend cutter. And it's really important when you look at your portfolio. If something is a dividend stock, it's really bad news to the street if somebody cuts their dividend. So you want to avoid those types of yield or dividend traps and really find the companies that have good, strong underlying fundamentals and businesses that can support that dividend over the long term, as opposed to something that's just paying out as long as it can and then is going to eventually hit a wall. Thanks,
so then
Kevin.
walk us through that selection process itself for those dividends, because effectively when somebody's buying an ETF, they're buying a basket. So what is the process behind selecting those companies, and maybe to your point, help mitigate those companies that might be cutting those dividends?
Yeah, I think you're actually making two great points there. The number one is the basket, right? What does the ETF do for you that you are going to have a hard time doing on your own? Quite simply, it's going to be a basket of securities, and the call writing against that is going to be handled professionally within the ETF. So it's a real convenience trade. If anyone out there has traded options on their own, of course, you can do so, but you're always dealing with expiries, rolling the options as they come due. Are they in the money, out of the money? There's a lot of activity, operational work, and portfolio management that comes to dealing with options. So dealing with it within an ETF on a basket of securities is a great convenience, and it is a really wonderful tool to put that in your portfolio. Now, the other point you're making is to how we look at dividend growers. Well, we think about two things. We think about, do they have a willingness to pay that dividend, right? And that's the positive or flat dividend growth rate. So we're simply saying, have they cut their dividend in the last 3 years, or are they maintaining dividend growth? So that's the willingness. And the second is, do they have the ability to keep paying that out? And that's the sustainability, and really looking under the hood of the company by analyzing the dividend payout ratio to just say, look, are their operations kicking off the cash that's needed to fund that ongoing dividend payment? And that's really critical in order to make sure we're gathering dividend growers and not dividend traps. And then lastly, we look to not market cap weight, so not by size of the company, but we have a bias towards what's the yield of the company. That combines well with the idea that we've already screened for those best dividend payers. So by putting a little more weight in those names, again, it helps the yield of the overall portfolio.
So Mark, let's talk about now a little bit more about the optionality, and specifically more about the implementation that BMO does. Try to give you good participation in the market while you're getting that higher yield. Here's that chart again that we had before, but now you're overlaying on top of it a little bit of our strategy and how our experience in this market is. Maybe you can speak towards that as I advance through some of the other slides around this.
Yeah, and this is a much more specific example if someone really wants to get into the numbers. Quite simply, here we've got a stock where of course we're owning the stock, and then we're covering it with the written call, which is being done at $60. So as that stock appreciates, we're capturing all that return up to $60. Let's say it's at $57, the left-hand side here. So you're capturing all of that $3 as it moves up. We're writing on half the portfolio. So as that price moves up and beyond that, we're capturing then half the excess return as we go forward. So that's why the slope of the red line starts to flatten a little bit, but it's still appreciating. So above that call strike, half our portfolio is still fully participating, where the other half, it's not losing money, it's just capped out between the stock return and the written option.
And that's all part of that trade-off for the additional yield you're getting in the market. Now, talk to us a little bit about the actual implementation we tend to have behind the scenes here for the respective ETFs. You mentioned those numbers, but let me give you more details on how we're actually implementing them.
Sure, diving in a little bit deeper now. We're pretty consistent that we cover on or about 50% of the portfolio. and that is equal across names. So in other words, we're not saying on this stock we want to overwrite, and this stock we don't. We do it consistently across the names. We always use out of the money options, and we always use short dated options. Now, what's dynamic about the strategy is we're always going to respond to what's actually going on in the marketplace. So today's a great example where for the last couple of months, volatility, or in other words, the risk in the marketplace has, of course, gone up quite a bit. And in doing so, option premiums get more valuable because volatility prices into those premiums. So when markets are more risky like they are today, we can write further out of the money and still capture, around the same level of option premium. So I think that's a great aspect of our dynamic approach. When markets are more volatile and there's potentially more returns to be had on the table, we write further out of the money so that we can better capture those returns. When markets are a lot quieter, a lot more benign, when there's less volatility in the market, we'll typically write a little closer to the money so that we're capturing around that same level of premium, but we don't have the same risk of missing out on upside returns.
Agreed, and kind of from a financial planning standpoint, that keeps that yield more consistent on a regular basis.
Yeah, I would say we're targeting a yield. So we do obviously want, with a income-oriented strategy, to not have a lot of surprises. So we want yield consistency, and that's why we try to target a yield. It's not locked in, but we're pretty consistent over time. Thanks.
Now, certainly there's been a lot of volatility in the marketplace, Mark. Maybe you can talk to us about why that's attractive now in this market for cover calls.
Yeah, certainly. Well, it's quite interesting. This is one of the few strategies out there where, when volatility picks up, it's actually somewhat beneficial to the portfolio. Yes, your underlying stocks, unfortunately, are participating, in the downswing that occurred in March. Now, when we look forward to April, you're capturing a lot of that upside. And as I mentioned from the previous slide, because you've got that higher level of volatility, we can write the options further out of the portfolio. So what we're showing you here is the VIX index. What is the VIX? It's simply known as the fear index. So it's an expectation of what markets might do without getting overly technical, looking out 1 year with one standard deviation, which simply means about a 2 out of 3 guess of where those market returns might be. So volatility for a long period of time was kind of in the 10 to 20 range. And as you can see this year, it spiked up through March all the way up to 80, which is quite a remarkable number, because if you think about that, that means plus or minus 80% returns 2/3 of the time over the next year. It's now come back down to below 40, which is still an elevated number. So people are concerned about the markets, but maybe not as much as they were in March. But again, the call writing strategy, because the risk of the market or volatility is one of the biggest inputs in the option pricing, it's actually advantageous to call writing.
So let's take that as an example on, for example, the cover call banks, a very popular ETF with people out there. I think people knew us to start off this strategy with cover call, with banks specifically. Maybe you can walk us through how those pieces all come together in the actual strategy itself.
Sure. I think this chart here is a great visual, starting with the dividend yield, which is sort of the darker pink section. You're getting that consistent yield from the banks. The Canadian banks pay a good dividend. Prices have come off a little bit of late, so the dividend yield has actually risen. So you're seeing that now up past 5%, 6%. So you get a consistent dividend yield to start. And then the total portfolio yield, when we add the lighter colored options on top of that, you can see we're keeping that very consistent. But what is changing is the blue line. The blue line is the percentage out of the money that we're writing the options. So you can see, generally through all of last year, we were about 3-4% out of the money as we wrote options. All of a sudden now, with all this heightened volatility, we're able to write 12% out of the money, but still keep, a very consistent level of premiums in the portfolio. So that's that dynamic implementation of the strategy really brought to light, where all of a sudden the portfolio we were writing at 3-4%, we're now out at 12%. So if that market continues to rebound, we've got that extra 8% of full room where the entire portfolio is going to participate in the upside. Thanks, Kevin.
So Mark, let's kind of give everybody kind of a quick summary how it behaves in various markets. And I have 2 slides I would mind you convey into the team, to the participants here. First of all, kind of give us your thoughts on the down markets and maybe rapidly rising markets and how cover calls tend to participate so we can understand the full trade-offs here.
Sure. I think, again, as I mentioned off the top, understand and be comfortable with the portfolio you're invested in, the underlying stocks. So in a down market, part of that decline is going to be offset by the call premium received. Why? Because that call, which is written out of the money above the current stock price, is just going to expire worthless. So of course you're just going to capture that premium and be done with that trade. Now, in a small decline, that's a great offset. In a period like March, where the entire market was going off by a significant amount, that's of course not going to cover the losses that you're receiving from the underlying stocks. So just like owning the equities outright with an uncovered strategy, down markets are not beneficial to the covered call strategy, but you will get a slight bit of outperformance from the call premium. In rapidly rising markets, that's when, depending on where you've written that option strategy, when you exceed that strike price, you'll no longer participate in the further upside of the market on whatever percentage of the portfolio that's written. So, if we're writing, like in the last example, 12% out of the money, well, if markets happen to go up, 20% or 15% over that time period, which is generally about a month, on that excess return, so let's say 15 minus 12, 3%, we're only going to capture half of that because we're half overwritten. So when markets really take off, that's your trade, is you've traded that excess return for the call premium that you receive. It's that old saying about money in hand, right? So what would you rather have? The possibility that outsized return or the cash in your pocket now?
And let's just quickly talk about sideways markets too.
Yeah, I think this is important as well, because sometimes people just look at a price of when I bought it and a price of when I sold it and don't wonder about the path in between. If markets are really volatile but not necessarily heading up or down, that can be problematic, because what's going to happen is you're going to hit those call strike prices more frequently as markets jump up, and then you'll capture as it goes down. So the path, not just the destination of the price, I think is quite important. A little bit of volatility, of course, is good for call writing, because you're capturing more of the premium. You can write more out of the money. But when you get markets that really whipsaw around, that can be challenging depending on the implementation of the call writing strategy. So just keep in mind where those call options are written is really going to be impactful as the markets move. But sideways markets can have different impacts, but just keep that in mind as you look at the strategies. Thanks.
And then just highlighting one of the strategies, one of our newer strategies in the marketplace, ZWG, a new ETF we launched in the marketplace, Global High Dividend Cover Call. And Mark, I know we've been talking about this in our own office for a while, but maybe give us one reason why this is probably something to put in people's radar, given that it does something in addition to the traditional cover calls we've just been talking about.
Yeah, we're quite proud to bring this ETF out to market, ZWG, Global High Dividend Cover Call, because it's got a lot of great things working for it. Number one, it's our portfolio of dividend growers, but applied on a global stage. So the names that you see in that portfolio, over to the right, like Microsoft, like IBM, like Johnson & Johnson, those are all names we know and that we're comfortable with. I've talked about the call writing strategy. It's consistent across the cover calls that we run, but we do a very effective job with it, making sure that we're light touch, that the portfolio can still go up, but that we're capturing that extra yield. So you see a distribution yield of 7.4% right now. That's an attractive number. The fact that it's global is quite interesting, because then we can really pick the best companies across the world. But the one thing that I've saved up, which is actually the first in Canada, is that it's also got an ESG overlay. So it's got a screen on it for companies that score positively in terms of environmental, social, and governance review and analysis. And by doing so, I think that's really bringing together another great aspect to this strategy, that for people that really want to align their investments with their own personal values. So in doing so here, yield, ESG, global, a lot of wonderful pieces that are coming together in this ETF, and we're really capturing a lot of interest in it right now.
Perfect. I think we have a few minutes for some questions and answers. Before I do that, I'll just put up here, we talked about yield and yield enhancement. I thought we'd leave this up on the screen while I go through some Q&A. These are the current yields of the respective cover calls we offer in the overall marketplace, and their tickers too, for you to do your own home work on it, or due diligence, that is. So looking at some of the questions here, Mark, if I can get your help on this. First of all, I'm going to go back there a bit. Well, there's a question coming about ZWK. It's one of our cover calls on US banks and the volume around it, and where it's going from here. Now, what I want to, maybe I can take this one, is when you look at new ETFs like ZWK, quite often it takes the time for an ETF like that, this is a question on volume, to get the volume up and to get participation with inside that ETF. A note about the ZWK, which is our US cover call banks ETF, I will note that it's following a very similar strategies and basket-wise to our existing two ETFs in that space. We have a hedged and unhedged one, ZUB and ZBK. So we're quite committed to focus on this for the longer term and support this in the marketplace, because we had good success with that one too across the marketplace. A few more questions coming in. Mark, ZBK.
Can I add one little thing, Kev?
Please.
Just always keep in mind, and this applies across ETFs, not just ours, that the ETFs, because they're open-ended, unlike a stock, they can always access the liquidity, the traded volume of the underlying securities. So that covered call, ZWK, what does it hold? Things like Bank of America and Citi and those types of massive names out of the US. So the portfolio itself, even if there's no trades on the day in an extreme case, it's supported by massive liquidity based on its underlying portfolio. Thanks.
A very good point to highlight, that it's always liquidity underlying. A couple more questions. A little more on ZWG here, Mark. Is there sector diversification in ZWG? How is it maintained? And also on the countries, or country diversification?
Sure. Can you flip back one screen, Kevin?
I am sorry.
Yes. If you can do that, I believe we have the sectors and countries up there. So you can see it is well diversified. Generally, I'd say we're being market aware, and we're watching both the sector and the country weights, and we're using soft caps within the portfolio. So we're trying to make sure that we have a well diversified portfolio. So we use sector and country caps. So you can see a higher weight in financials at 22%, healthcare at 19%, tech at 13%. So it's very well diversified by sector. And then if you go to country, it's about 60% US, and that's just reflective of the size of the US market relative to the rest of the world. Then you can see it's very well diversified into Canada, into Europe, Australia's in there, Japan's in there. So we're making sure, again, at a country level, that we're well diversified, because what we want to do is watch out for hidden risks. So we don't want to over concentrate by sector or industry, or even by country, which would be less of an effect, but just making sure that it's a well diversified portfolio. Thank you.
And let me just clarify something here too. A good question came in to explain the yield itself. And so what you're looking at when I'm showing this screen here, this is the annualized yield. So yes, we do pay monthly distributions with these respective cover calls, but think of this as the annualized number, and there's a fraction of this paid out each month based upon what we're earning in the actual portfolio. And what I'm saying, based on what we're earning, going back to Mark's comment, there's a dividend yield plus the optionality that portion is paid out each year, and the annualized number is what we're showing you here. I think we have time for just one more question. Let me select that out there. Bear with me. Oh, quickly there, Mark. How is that yield taxed? That's a good question. We talked about the beginning being a tax benefit, but maybe you can quickly talk about the yield and how it's taxed.
Sure, thanks, Kevin. So unlike bond interest, which is taxed fully as income, there's actually tax efficiency within the covered call solution. Number one, from the dividend, which of course has taxation advantages. So, you know, when you think about, let's call it around half of the yield coming from dividend, you've got the efficiency there. Then the call premiums are actually taxed as capital gains. Now it gets a little bit complicated, but just realize there's two sources of capital gains in a covered call portfolio, one from the premiums and one from any buying and selling of the securities. So at the end of the year, you might actually get some return of capital if there's offsetting losses in the portfolio versus the options or vice versa. And it's actually what we would call good return of capital, because we're not eroding your capital. You're not eroding your invested amount in the ETF, but we're actually giving you a more tax efficient yield. So typically you're going to have a consistent dividend. You're going to have some level of capital gains, and depending on how that shakes out at the end of the year, you might get some ROC or ROC, return of capital, combined in with that capital gain. So far more tax efficient than something you're going to get out of fixed income or a note structure, other places where you might be looking for yield. Thank you.
Well, thank you, Mark. And I'm going to close it off here. I'm going to say to the audience, thank you for taking time today to join us in this session. And thank you, Mark, for participating and giving us your expertise. I want to highlight to everybody out there, if you're looking for regular insights on the overall marketplace, something we've been doing jointly with the TMX since this crisis has started. There's a link at the bottom. I don't know if you can access that link. If you can't access a link to register, just Google Prosper, BMO, and TMX, and it'll come up too for another way. So thanks again for joining us today. I hope you take all the time and effort to join us for the next presentation.